In this lesson, we're going to discuss more about taxes and specifically average versus marginal tax rates. We're going to start with the average tax rate. The average tax rate is the portion of taxable income paid in taxes. So how much did you pay in taxes divided by your taxable income, or your tax liability divided by your taxable income. The marginal tax rate, on the other hand, is the tax rate payable on the next dollar of taxable income. So if you were to make one more dollar of taxable income, what would that extra dollar be taxed at, regardless of your tax rates on any other dollars that you've already made? The marginal tax rate is more important when we're making financial decisions for our firm, because if we're deciding on taking on a new project, we want to know what earnings are we going to be able to take home with us, and that means we need to know what tax rate is going to be applied on those new earnings or on those next dollars or extra dollars of earnings, and that's going to be our marginal tax rate. So this is going to affect our financial decisions. Let's try an example. Suppose your firm earns $140,000 in taxable income. What is the average tax rate in the progressive tax system? So here we're looking for the average tax rate. And as we said, our average tax rate is our tax liability divided by our taxable income. In a previous video, we already calculated our tax liability for $140,000 in taxable income using the progressive tax system. This is our work from that previous video, and we calculated what we owe in each particular tax bracket. We added all of those tax liabilities together, and that gave us a total tax liability of $37,850. So if we return to our problem, our average tax rate is our tax liability divided by our taxable income, and we calculated in a previous video that our tax liability was $37,850. The problem tells us that our taxable income is $140,000. So if we divide our tax liability of $37,850 by our taxable income of $140,000, that comes to 0.2704. That gives us 27.04% as our average tax rate. Now let's calculate our marginal tax rate. Suppose your firm earns $140,000 in taxable income. What is the marginal tax rate in the progressive tax system? In this question, we're looking for our marginal tax rate. That means we're really asking that if we earned one extra dollar, so if we're now earning $140,001, what is the tax rate on that extra dollar that we've earned? If we look at our progressive tax table, we need to figure out where $140,001 is, and we can see that it's in the fourth bracket. So if we earn one more dollar of income, then that extra dollar is going to be taxed at 39%. That means that our marginal tax rate is 39%. Our marginal tax rate is important to us when we're making financial decisions about our firm. If we're making decisions that are going to bring us additional taxable income, so for example, a new project that's going to lead to higher earnings, then we know that those taxable earnings are going to be taxed at 39% because they're above what we're already earning. And knowing that marginal tax rate will help us to figure out how much of those earnings we get to keep after taxes. So in a progressive tax system with the particular tax brackets that we were looking at with those tax rates, our average tax rate was 27.04% and our marginal tax rate was 39%. Now we'll look at a flat tax system. Suppose your firm earns $140,000 in taxable income. What is the average tax rate if the flat tax rate is 21%? Again, our average tax rate is our tax liability divided by our taxable income, or the portion of our taxable income that we pay in taxes. In a previous video, we calculated our tax liability to be $140,000 times 0.21, which gave us $29,400. So if we now plug that into our average tax rate equation, so the amount we pay in taxes, $29,400, divided by our taxable income of $140,000, that gives us 0.21 or 21%. That really shouldn't be a surprise because the way that we calculated the average tax rate here is just a different algebraic representation of the way that we calculated our tax liability. They're actually the same equation, but the top one is solved for the tax liability, whereas the bottom one is solved for the tax rate. If we were to ask the question, what is the marginal tax rate if the flat tax rate is 21%? The marginal tax rate would also be 21%, because if we earned one more dollar of income, that extra dollar would still be taxed at 21%. So in a flat tax system, the marginal tax rate, the average tax rate, and the flat tax rate are all the same. And in this case, that's 21%.